Hello and welcome. You're watching All About Your Company here on ET Now. I'm Harsh Saita. Today we're going to be talking about a pre-engineered building company. This is new age, of course, to a certain extent, but it's also leading to reduced lead times in construction work, whether it's factories, whether it's EPC contract execution, all of that is getting easier and faster as a result of this, and therefore it's a whole new industry. As one would describe it, the Kirana stores are the typical old school building construction companies, and then you have these slightly new aged kind of companies which are doing a faster role in terms of lead time, in terms of delivery, and Interarch Building Products is just one of them. First off, what I want to know with regard to this company, first, whether execution post the monsoon has picked up and whether they can do 20% volume growth in FY26. That's my first question. Mind you, very strong guidances that the company has given, and all of that depends on capacity coming on stream. If they are to meet those guidances, capacities need to ramp up substantially, and we'll try and understand what the capacity and CAPEX timelines therefore are. That's point number 2 of what I want to know, if we can pull that up. Point number 3 is with regard to how confident is the company of doubling FY25 revenue by FY28. It's a very steep ask, 2,900 crore in terms of top line. If they are to do that, it's going to be a very, very tall ask, and it will also require a very strong surge of CAPEX into FY28. The current CAPEX that they are doing should take care of around 2,500 odd crore of revenue, and therefore beyond that what they're doing will also be interesting to understand. What that does on margin trajectory will also be very, very crucial. 2,000 crore of top line by FY27 is the aspiration, and therefore what the drivers will be with regard to margins in case of a significant uptick in terms of top line will be crucial to understand. Also, how does steel price play out in terms of delivery and in terms of margins is what I'd want to understand slightly better. Likely they are passing it through completely, and we'll understand that from, or we'll get a color, or we'll get a confirmation from that from management when we speak with them. The fifth piece is with regard to the next leg of growth. What are the growth levers and what are the drivers going forward? Mind you, 82% of the top line comes from repeat orders, and therefore we'd want to understand as to whether how much of new traction or new client wins are coming through as well. We'll get some color on that. And the last piece is with regard to competition. Now we know that to a certain extent, each company has built its own niche within the pre-engineered building space, but whether that can be seriously differentiated and whether that differentiation can be carried through will be a question which we'll want to know. So some of these pieces we'll try and piece together over the next 30 minutes. Now first, let's try and understand what the company exactly does. It undertakes turnkey pre-engineered buildings. That's what it does essentially. So it takes on these projects where it enables for construction of, say, a factory. Thereafter manufactures, based on the requirements of the factory, manufactures all of the components in-house at their factory, transports them, and these are all fabricated based on the measurements which are required by the company as part of the order. And thereafter, all of these components are transported to the factory, assembled at the factory, and therefore what happens is the construction happens at a far quicker pace versus having a standardized set of materials being brought to the factory and then construction taking place. So that's where the differentiator lies, where the PEB industry is concerned. It's the second largest integrated PEB capacity in the country is what the company has. It was incorporated in 1983, now has 42 years of experience in steel construction, thereafter got into PEB. It has 5 manufacturing facilities across India, dominant in the south and the north with regard to its manufacturing facilities. They are also setting up one in Gujarat, and therefore that will give them a footprint to West India as well. But let's try and understand the products better. I did explain how the business model works. They win orders basis the the exact specifications they manufacture in their factory and thereafter transport and set it all up over there. But broadly, this is the way in which these are some of the products which they do. They specialize in what one would call skin and bones of the factory, which is the walls, the ceiling, and everything relating to it. So it could mean insulation from rain, from walls and the ceiling. So all of that is what they specialize in, which is Interarch in particular. That's their specialization, including exhaust of a factory, etc. All of that is fabricated and sent and constructed there. Now, let's talk about geography. It's 100% domestic. The operations, they have 5 design centers, 5 manufacturing facilities, 2 under construction, and 10 marketing and sales offices. The current capacity is around 201,000 metric tons. Capacity utilization is between 80 to 90%, so almost entire capacity utilized. They have a whole host of clients, but predominantly in the industrial space and manufacturing, including industrials. So you'll get that whole host of sectors which they cater to, including power, renewables, e-com, electronics, cement. So the new age plus the old age, they cater to all of it. In terms of the business model, I've explained it to you. They design, engineer, manufacture, erect. The roofing and cladding is what they specialize in, which I spoke about, the skin and bones of the factory. They supply and install metal systems to ensure that that happens. The ceilings, including the waterproofing, is done, and a lump sum one-stop shop price is provided to the company. In terms of, now let's talk about predominantly the metrics. Let's talk about the P&L. The growth has been 20% CAGR over the last 3 years in terms of top line. This one listed in August of 2024. When you look at H1 FY26, well on course versus what the management guidance is in terms of top line growth. EBITDA too has grown at a far faster clip. Margins have expanded very, very sharply, especially in FY23. Thereafter, it's been a linear growth. And what we've seen, therefore, is a CAGR of 57%, largely on a very low base where EBITDA is concerned. Profit also, of course, obviously, very similar glide path with regard to EBITDA. And therefore, profit, of course, has bumped up far higher on a far lower base. And that's what you've seen play out. But a very strong growth, 20% last 3 years, and therefore, we've given this a thumbs up. Let's now look at what it's done in H1. You'll get a quick snapshot on your screen. Thereafter, we look at how margin trajectory has fared, and you'll likely see margin pick up because that's exactly what's being witnessed and what we've spoken about as part of the P&L account. Margin pickup has been sharp. It's gone from sub 4.5% to now nearly 9%. The guidance is to hit double digit shortly. In terms of order book, the book to bill generally ranges between 0.8 and 1.1. Currently, it's sitting at the higher end of that band of 1.1 times or 1.05 times, I can call it. That's the book to bill. But broadly, this is the way in which the book to bill has evolved and has stayed. So fairly resilient, stable, steady state. They've been fairly consistent with the way in which they've approached the book to bill as well, as you can see. In terms of balance sheet now, it's a clean balance sheet. And what stands out for me is the fact that there's very low debt on the books. The borrowing number is just about 17 crore in FY25, 9 crore H1 FY26. But the cash bank account is around 250 crore. Utilization of that is something that I'm seriously interested in understanding because the CAPEX guidance is 150 crore. I'd be very keen to know the fresh CAPEX that is in the pipeline, which is why they're sitting on the cash that they're sitting on. In terms of cash flow conversion, that's a bit of a pain. This has been a pain point. We've not seen that happen. And that's something that I'll probably quiz management on as well, that cash flow conversion is not playing out, probably because there's some amount of that sitting in inventory. We'll try and understand that better. In terms of return ratios, there's been a significant uptake along with margins. The return ratios have gone through the roof. They've gone to 20% plus and they've stayed there. Now the question of course is on the pace of CAPEX that they're doing, whether return ratios can remain there is really the question. But return ratios have gone from 5% to 10% in FY22 to 31% to 29% in FY24 to 25% in FY25. Let's talk about shareholding now. In terms of shareholding, pre the IPO, it was at 88%. It was unlisted and therefore we don't have or rather we've not quantified the FIDI public participation there, but you look at the shift thereafter and you'll see some of the numbers, 59 to 60 odd % in terms of promoter ownership, which is fairly healthy, and therefore we've given this a thumbs up. You've seen FIDIs also participate. It's a 3,500 crore company, and therefore when 60% is owned by promoters, very little that FIIs, DIs can nibble in terms of a stake in Interarch. But nonetheless, there has been some small stakes which have changed hands and which FIIs, DIs currently participate in. Let's talk about management commentary now. FY26, they've guided for 17.5 to 20% volume growth. I'm hoping that they do that at the higher end of the guidance. The margins are expected to be 8 to 10%. CAPEX of around 150 crore is in the pipeline. FY27, the top line aspiration is 2,000 crore. They're likely to double revenue versus FY25 by FY28. That's the aspiration. 40,000 MT is expected to come on stream very soon. 500 crore should be the additional top line as a result of that. And 25,000 MT is expected to be added in Andhra by Q2 FY27. So that's the very immediate target out of the 40,000. Double-digit margins is what they are aspiring for as operating leverage starts to play out. We'll ask all of these questions, try and understand it better. In terms of valuations, if we just look at the current 1 year forward, it's at 21 times. You look at the 1 year range of 20 to 30, it's a bottom end of that range. Mind you, there's not a very long chart or a large chart that we have. We just have 16 months of trading history here. And the 1 year average is around 25 times. In terms of the numbers extrapolating, we'll try and extrapolate that at the end. But that's broad brush, the snapshot of it. Let's in fact give you a snapshot of all the valuation and all the metrics, all the parameters. Give you that snapshot on your screen in just a minute. But what we'll do is we'll go across. We have Manish Garg, CEO, Interarch Building Products, joining us this afternoon to give us a sense. Manish, great having you. Let me first start off by understanding from you how you're expecting execution in H2. And I'm not asking Q3 in particular. Are you seeing significant ramp up because you've guided for 17.5 to 20% volume growth? Do you believe you can be at the higher end of that guidance at the end of FY26?
Yeah, good afternoon. Thank you for having me on the show.
Great having you, Manish.
Yes. So we are in the higher end of the execution cycle. And as you would see, even in the Q2, our execution speed was far greater than the Q1. And we continue on that trajectory to deliver faster as we ramp up our utilizable capacity. So the answer to your question is a definite yes, that our execution speed is increasing day by day.
Okay. Does that help you clock 20% volume growth this year, Manish?
Yes, we had earlier guided for 17.5. We raised it to 20%, and till H1, we actually delivered far greater than that, which was about in the range of 40%. So we continue to be very bullish about it. And yes, it will be in the higher range of the guidance.
Would you therefore believe that the FY27 guidance of 2,000 crore in terms of top line, you'll be very close to that in FY26 itself?
I would say as we go along, and as you would see, that our H2 is generally better than H1 if you go by the history, and the likelihood of us achieving a number which is higher than our guidance is very likely.
Okay. Manish, how should one look at capacity ramp up? Because from what I understand, and correct me if I'm wrong, the only possible headwind or possible risk, if I can call it, not even headwind, risk, if I can call it, to you achieving maybe 2,000 crore in FY26 is just capacity coming on stream and capacity utilization being nearly full. You're at 80 to 90%, if I understand right. So are you ramping up fairly quickly in terms of your own capacity, which will help you get to maybe 2,500 crore, which is the next threshold, far faster than what you would have anticipated?
Yeah, so there are two aspects to it. One is the volume growth, and second is the volume growth continuing and getting into the rupee terms. So if you see for the last 5 to 6 months, the steel prices have played out to be on the lower cycle. So if you see, our volume growth has been a bit higher than our turnover growth. So turnover growth really depends on, quite obviously, your volume growth, but then also on the steel pricing that plays out. So in terms of our installed capacity, we are definitely utilizing much more of it. We are ramping up very, very quickly on our new plants, which is the expansion that got commercialized in our Uttarakhand plant with a new capacity addition for the box line. And in Andhra, where we commercialized the phase two, which is very fast ramping up. So yes, the volume growth is going to be a function of our capacity utilization going even beyond 88 to 90% during the H2 of this financial year. And next financial year, our Gujarat and our Andhra Pradesh new unit, brand new, both are going to be operational, let us say, somewhere in the end of the Q2 of FY27. And once that starts to kick in, quite obviously, doubling of the turnover about 4 years ago, turnover is a very potential likelihood as we ramp up even those new capacities. In terms of turnover, it will really depend on the steel pricing. Till last month, they were pretty stable or in the lower circuit. This month onwards, they have started to inch up a little bit, which has been traditional in the quarter of Jan, Feb, and March. So pretty much on an average basis, we should be growing handsomely in terms of our capacity utilization.
Let me unpack this a little bit, Manish. So your current capacity is at 201,000 MT, am I right?
That is correct.
And Q2 FY27, this adds another maybe 65,000 MT?
That is absolutely right. However,
Correct.
the entire 65,000, the kind of business we are, 65,000 is really the installed machine capacity. But though it will all get commercialized, let us say somewhere in the end of Q2 next year. However, for entire capacity to kick in terms of utilizable, it will take, I would say, another 3 to 4 months before it actually comes, to deliver the volumes, because the ramp up happens in 3 to 4 months after the commercial production starts.
So am I right in conservatively saying that it will only happen in Q4 of FY27? The full impact of the numbers will only be felt in Q4 FY27?
Yeah, so I think I wouldn't really like to put a percentage, but I would say part of it will be Q3 next year for sure, and a little more than in the Q4. But I would very definitely say that the next year, Q1, this entire 65,000 should start to play in. So it'll actually ramp up gradually if I was to explain you that.
Understood. And where does that take your maximum potential top line? At the maximum capacity utilization, where does that take your top line, if at all one were to just try and understand that or put that in perspective?
Yes, so just to put that in perspective, we are right now about 201,000 metric tons. When we add another 65,000 metric tons to it next financial year, we will be at about 266. So that has a revenue potential in a steady steel cycle, steel price cycle, I should say, to, I think, in the upwards of 2,700 crores to 3,000 crores. That's the capacity we will build in.
Understood. And Manish, are you seeing that kind of traction in the business? I know that order wins have come at you thick and fast. You're probably sitting at a book-to-bill which is on the higher side from what you've traditionally done. But talk to us about new customers adopting the kind of technology and the kind of work that you're doing. How is new customer adoption playing out, and how are you upselling to your existing customers? Talk to us about that.
So I should say that the pipeline remains very strong, and so is the order book. The conversion from the conventional concrete buildings in the commercial as well as the data center and the new age sector, which is the semiconductor and the other aspects, which is the electric vehicle. Just to tell you, just the electric vehicle factory, for Ashok Leland that just got inaugurated 2 days ago in Lucknow was actually built by us. So that's where the electric buses will be manufactured by Ashok Leland. That has been done by us. So the conversion is very, very fast. And I should say that this is one of the best times that we are experiencing in terms of the order conversion and the pipeline and the new sectors opening up. So we don't see any reason for the order book or the pipeline not to be as strong or even stronger than what it currently is. So the traction is very, very good.
Manish, I have at least 3 questions and I have only 3 minutes, so I need to keep this quick. The first piece is when you get to 27 to 2900 crore in terms of top line, where do your margins go?
So I would say there is only that much of operating leverage. I heard you saying operating leverage. So there was, of course, a lot of operating leverage that was waiting to be unlocked 2-3 years ago. So that quite a bit has been unlocked. Yes, we are working on a lot of factors on the internal efficiencies, which should take our margins a little better than what they are. But I would say you can safely assume them to be in the similar or a little higher range.
Okay. Question number 2, Manish, is with regard to cash flow. Why isn't conversion happening?
So I would say as we go along, Interarch's average order size has increased by 4x than traditionally what it used to be. So we are booking and executing far largish orders. We have orders now which are largest in the country, like 300 crore plus and 200 crore plus. So if you look at the inventory cycle or the order to cash cycle, it's a bit longer. So I would say it is by design and it is by the order size cyclicity, and we don't see this as a challenge at all. It is by design that it has become like that.
Got it. Talk to us about cash flow and therefore CAPEX as well. You're sitting on 250 crore of cash. Some of that likely will be used for working capital. If I'm not wrong, please clarify. 150 crore is going to be used for CAPEX. Talk to us about what do you do with the kind of cash you're sitting on and how does that shape ROCE and how does that shape your CAPEX plans going forward beyond FY28, beyond the 266,000 MT that you're setting up?
Yeah. So our cash utilization, because as you would have seen that we have not really picked up any term loans or anything to fund our projects. So all our current projects are also being funded through our internal accruals. That's number one. Number two, it's a high working capital kind of a business. So some of it is going to be used in the working capital. Also, we are not stopping here, and we are internally discussing to put up new projects even further. So I would say that we will have future plans also to add the capacity as we go along, depending on how the demand is. So a lot of CAPEX eventually we get utilized once we decide to put up the future projects.
Okay, Manish, it's been a pleasure speaking with you. It's been great understanding this and diving deeper.
API coolest है